This is Brian with Leelyn Smith and the second quarter 2021 update. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, well, we're going to talk about the $6 trillion total of $6 trillion that President Biden is getting through and trying to get through Congress. It is the largest spending package we've had since President Roosevelt's New Deal in the 1930s, and it's raised a lot of questions. Questions such as, how much spending is too much? And do deficits even matter? Should we even care about this? And then the subsequent possible inflation, and then interest rate or Federal Reserve activity. There are a slew of things to talk about. But at the end of the day, does this impact us? Does this impact our investing? To answer that, we need to look at a few things. First is the concept that deficits don't matter. This is not an actual theory, this is an accounting principle. And this is based on the idea that any government deficit must, by definition, be a private sector surplus. Now, while that may be true in the accounting world, what's really the bigger worry is the amount of spending. And it's important to know that the government doesn't have any money. The government gets money by taxing businesses and consumers, us. And because deficits occur when more is spent than is taken in, we can count on taxes being increased at some point in the future. Now, mainstream economics says that deficits and debts do matter, and that they lead to inflation, which invariably leads to unsustainable payments. And when inflation rises and interest rates are increased because of that inflation, that debt that we have taken on when interest rates were lower, i.e. right now, becomes more expensive because it's at a higher interest rate. And that makes those payments even harder to make. That inevitably leads to belt tightening, which means higher taxes, higher interest rates aimed at slowing down the economy. Now, on to investing. Higher taxes and interest rates theoretically and generally mean businesses earn less or less profits. Now, the silver lining there is stocks have performed relatively well during inflationary periods, likely because they're able to push through the cost to the consumer. So it ends up being the consumer, i.e. you and I, pick up the bill, if you will. Bonds are a different story. As interest rates rise, so you have a higher interest rate than you used to have, the value of current bonds goes down, because the new bonds that will be issued will be at a higher rate. So the value of current bonds goes down. So bonds may be hurt a little bit by this. Bottom line is this though, our fundamental investment strategy is based on the highest quality companies that have the strongest competitive advantages. So interest rates, inflation rates, even volatility, they don't impact our strategy at all. So we're okay there. Now for the planning side of the fence, I think it's important to note that if we were to recommend to our clients that you can spend all you want, it doesn't matter, we would be in violation of our fiduciary duty, number one, and number two, their financial plan would be worthless at that point. Now, while comparing deficits to financial plans is not an apples to apples comparison, it does bring up an important point, and that is responsible spending. At some point, too much spending, whether that is in a financial plan or at the government level with deficits and so on, it has to be reconciled. And at the government level, it can mean too much drag on the private sector, i.e. too much taxes, too high of interest rates. And the private sector is what drives the economy. Thus, deficits matter, if only to keep spending in check. That's it for this time. Remember to keep your eye out for our next video. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. We'll see you next time.